Hey folks, apologies for the late podcast. I was crook last week, so we couldn't make one. And this week, in its place, we're just going to have me rabbiting on a little bit. So it's probably similar to the premium signal and noise. Okay, so let's kick off. It's just an audio only, by the way, which is probably a good thing. Okay, the ceasefire in the Iran-US conflict is dead in the water. So we're back to war. And interestingly, I think we're back to square one. So we can probably expect some excitement as we've seen in the oil market, which is not a bad thing if you're holding oil stocks. And I think we also now have to reconsider the downstream effects on other things such as helium and fertiliser. I think there's still a major concern there that we will get supply shortages. It's a sort of wait and see approach, but I suspect at some stage we are going to get a revisit of those issues and some concerns. This war is a long way from being over, and what I mean by that is I think this has probably got another 12 months to go. This is not something that's going to be sorted out very swiftly. So from that point of view, we'll continue to monitor it. The big problem there, I think, is the uncertainty. If you have a look at the oil flow or in the oil price as well, what you're seeing is a lot of volatility. Oil went from basically, I think it was about 60 to about 110. Now it's back to, I think, about 75, but it's been below the price when the war started. The Strategic Petroleum Reserve in the US is nearing its lowest point. We've had Chinese demand destruction, so there's a lot of demand management going on at the moment. But that can only be temporary until we start to seriously run short of oil. So again, hold tight. We'll keep an eye on that and keep you posted. In terms of markets themselves, one of the things the boys and I are concerned about and keeping a close eye on is the level of debt that is starting to come from both the private sector and, for example, in Australia, that's people borrowing for residential property. In other markets, there's a lot of people borrowing on margin to speculate, which is not necessarily a bad thing, but it's not a great thing when the Cape's at 42. So again, we'll keep an eye on that. The other thing that is distorting markets a lot along that line is the people are speculating in leveraged ETFs. Options have been another huge boom. Those two are signs that you should be very careful about your portfolio exposure, especially to the US stock market. As we know, if the US falls a lot, everyone else will go down with it. So it's generally you just need to be a lot more active in monitoring your portfolio, and don't be afraid to take profits. Whilst that can look painful in the short term, it's probably not a bad thing if we're expecting a market decline at some point. As we've sort of put on the socials and in the premium newsletter, all the indicators that we use are screaming extremely overvalued. And so at some point that's got to mean revert. It'd be great if we could tell you when, but we can't. So the idea is to just maintain a fairly low exposure at the moment. One of the big things with the geopolitics is military spending. Europe is starting to spend a lot of money. Donald Trump has asked Congress, I think, for $1.5 trillion. The Japanese are now spending a lot of money. The Australians are spending money. So you're going to see a boom in military spending, which may well lead to more inflation down the track. The reason why that's important is because when the government says we want to build some bombs and bullets, they get those resources, which is, copper, iron ore, aluminium, bauxite, all that sort of stuff. The government gets what it wants. So from that point of view, other things that use iron ore, cars or things like that, they may well become more expensive because the government is now competing in commodity markets to secure those resources. That's what we've seen in the recent past, and I think we can expect that over the next 5 or 10 years, hence the reason why we think commodities are actually fairly attractive over the long term. Okay, the other point we've got here is the OECD came out and said Australia's terrible, the Australian economy is awful. I think they've sort of exaggerated a little bit. We've suddenly gone from being everything's okay to suddenly being extremely pessimistic. There's no doubt that falling property prices help promote that narrative. It's the same in stock markets. When stock prices fall, everybody suddenly becomes bearish and thinks everything's terrible. And when stock markets are booming, everybody thinks everything's fantastic. I think at this stage, the OECD was talking about Australia's productivity. Naturally, a lot of local economists have cottoned onto that. Australian productivity is fairly low, but there are some reasons for that. I won't go into them here, but we'll deal with those over the future. But needless to say, one of the ways which is seen as controversial, but is actually not, is raising wages. When you force employers to pay more for labour, that's when they go looking for innovation and then technology adoption, and that generally frees up those staff to go somewhere else into more productive investments. So again, we'll see if Albanese and Chalmers pay attention to the report and respond to it, or whether they'll just continue to monitor the economy and go along as they are. The other thing was the obvious falling house prices. They haven't actually fallen that much, but you'd think it was Armageddon coming when prices fall 5%. If you're up 100 or 200% over the long term, 5% fall doesn't worry you, or shouldn't worry you too much. But again, what we're seeing is that this may well be the start of a long-term decline. That's something that you're going to have to keep an eye on, especially if you're a property investor. Okay, what we don't like, again, we're just talking about Cape valuations. Everything is really expensive in the US. At some point, this cycle will turn, and that's when things might start to get a bit ugly. I'm looking at the moment to see, the hard part is determining whether it's a GFC type crash, which is 18 months of 50 to 60% drawdowns and some chaos, or whether you get a longer 1965 to 1982 decline, which I'm more or less thinking that's where we're going to be. We'll have to see that, but I'm working a paper on that, and we'll get that out and talk about it on a podcast in the near future. I'm leaning towards that 65-82 scenario. Part of the reason why is there's some similarities there, but the other concern I have is simply that there is absolutely so much debt in the system, and things have gone absolutely crazy, that if we were to let it blow up and not do anything about it, meaning governments and central banks, we would have a very serious decline and a lot of chaos. I don't think the governments will let that happen. And so what I think they'll do is manage the economy much more, which is what they're already getting into, managing the economy much more over the next decade by doing things like halving the capital gain or doubling the capital gains tax, making disincentives in certain areas. So as I think we've said in the last couple of months, Albanese and Chalmers are sending people a message that they're not really that interested in people just swapping properties, because that does nothing. except create arbitrage opportunities, but also pushes up the price and basically favours investors over those who want somewhere to live. So I think that's just the start of it. I think you'll see more and more of that, where what they will do is maybe provide more incentives in other areas. So just as an example, I'm not saying they're going to do this. The government might say, okay, well, we'll release a critical mineral bond and it'll pay 7%. And so investors may well go and put their money there rather than buy a property to speculate in that market. And so at the moment, I think what they're doing is they're sort of disincentivizing. And at some point when there's enough cash sitting around and investors looking for a yield, the government may well provide some incentives there. But again, we'll have to wait and see how that pans out. Needless to say, the current Cape is at 42. Just to give you an idea, that's 4.5 standard deviations above the long-term trend. What that really means is that it's going to be a really, really painful decline. And this is, again, not unusual throughout history. We've come to think that these things are the rule and not the exception, and it's actually the other way around. There's no surprises in this secular bull market, because when it started in 2009, the Cape ratio was really about 11 or 12, which is super cheap. So here we are at the other end, where we're now at 42, and long-term investors, Jeremy Grantham, Fred Hickey and others, are basically saying this is the worst market that they've ever seen. This is the biggest bubble, driven, of course, by AI. And so when the market reverts, it's probably going to be pretty painful. Again, we don't know when, but we're just going to have to wait and see how that plays out. One of the things I've noted of recent times is the earnings expectations for the future are extremely ambitious. I don't think they'll play out, and that may be the catalyst for the downturn. But as I said a few months ago, the boys and I talked on the podcast, the idea is not trying to predict what's going to happen. The ideal position is to have your portfolio positioned for what's coming up, whatever it is. That gives you a different way to invest. And at this stage, you should probably be leaning, as we said, to being more cautious. One place we do like is energy. We continue to like energy, and I think we're going to like energy for the next decade. So, again, if you're in energy stocks, you can rebalance if you like, or you can take a longer term perspective. And they, again, look very attractive. We'll be delving into more commodities throughout the rest of the year. One of the ones we've had a look at recently is nuclear. I think there's going to be a nuclear renaissance, and I think there's going to be a lot more acceptance of nuclear in the future. That will be one issue that the Albanese government is going to have to probably deal with. We've got an agreement this week or last week with India about nuclear, and we'll probably see more of that in the future. Okay, one thing in the Watch Your Edge section is really just highlighting this idea of buy and hold as a market staple. I'm here to tell you that 100 years ago, nobody talked about buy and holding stocks, and in fact, it was common for people to buy and sell stocks quite regularly. We've got a little chart, a little diagram there in the podcast notes. Have a look at that. And what I'm really trying to get across to people here is, look, when the market's crazy, there's no harm in holding cash or alternative assets. It might be, cheap energy stocks and that sort of thing. But don't think that you have to be fully invested when stock markets are going absolutely crazy. That's not the idea that we want you to consider. So again, just remember, whilst it seems a little bit painful, it's a really wise move to just look at valuation. And again, just think in other terms, whereas, as we say, if you go to the supermarket and strawberries that are normally, say, $4 are $15, generally most of you would say, oh, okay, well, I'll give strawberries a miss. It's exactly the same with investments. If the market's 3 or 4 times overpriced, there's no point in going because you think you're going to miss out. Generally, you're not going to miss out because there's going to be a large decline. And when that decline comes, the benefit of missing out is that you've now got the cash to put back into the market when it's cheap. Righto. Okay, we'll leave it there, folks. We'll be back to our regular podcast scheduling next week. And so I hope this has been useful. Apologies once again for the lateness, but we'll see you next week. Cheers, folks.